Dividend investors, bonjour, Mike Giroux here, founder of Dividend Stocks, Rocks, and Passionate Investor. You know, this is the time of the year, and I'm not talking about Christmas, but I'm talking about the Canadian earnings report. Last week, the Big Six came in with not that strong of a reports, but still they reported their earnings. And what I found very interesting about Canadian banks is they tell you a lot about what is going to come up next. So let's take a look at what happened over the past 10 months on the market. Actually, past 11 months, so time flies. Year-to-date return for all the big six. As you can see, we have like really two types of categories here. You have the resilient bank that went through this very bad year, but still generating some kind of like positive returns or barely losing money with TD. But with the dividend added, that's pretty much how they saved. So the stock price declined a little bit, but then boom, dividend came in. So Royal Bank, BMO, National Bank, and TD kind of created this buffer where you can go through a very bad year and still make some money out of it. Unfortunately, CIBC and Scotiabank are lagging. It has becoming a recurring narrative for the past 5 and 10 years. It's kind of like CIBC and Scotiabanks are fighting to know which one will be the worst. As you can see on the graph, though, on CIBC, when they declared their earnings, it was definitely not a good quarter, and then the stock plunged for about 7% on that day. So definitely not great news here, and this is what we're going to look at today. So this is by far my favorite chart to show you what happened this quarter, especially when you are an income investing investor or a dividend growth investor like me, because we're talking about dividend growth, and payout ratios. As you can see, only one bank forgot to increase their dividend, but even worse, Scotiabank is showing only a 3% dividend increase for the entire year. So what I did is I looked at the first dividend payment in January, and then I look at all the dividend increases, because you know there are some companies, some banks such as BMO or Royal Bank that are increasing their dividend more than once a year. So typically twice a year. So they come in with small increases such as BMO at 3% or Royal Bank at 3% as well. Even CIBC chipped in like at 2.4. But when you look at the total year increase, well, then we have mid-single to double-digit increases, which is quite surprising. I don't expect that to happen every time, but National Bank and Royal Bank has been the most generous banks this year with 10% and 11.5 for National Bank. I mean, I don't meant to tell you that National Bank is my favorite, but when you look at the numbers, they speak for themselves. TD was like the bank that got the best quarter, and they came in strong with a generous dividend increase. But the thing is, it was only once this year. So when you put it on a larger scale, they're pretty much in the middle of the group. So not bad, not good. But I mean, 7.8, like 8% increase. It's still very good. But when you look at other banks, it's pretty a standard dividend increase. In terms of earnings, as you can see, and we're going to talk a lot about provision for credit losses today, but you can see that there's a wide range from CIBC with EPS down 17%. And this explains a lot on the plunge the stock had on that earnings day, up to TD at +4 that had the best quarter among all the big five. In terms of yield, we can also see that there's a discrepancy here. Again, we have like two types of banks. Those that are resilient, offering you a like 3.75, close to 4% yield, and 4% for BMO. And then you have the laggard, again, CIBC and Scotiabank at 5.9, 5.5. As you can see as well, in terms of payout ratio, this reflects it as well. The two companies that are lagging, they didn't have a good quarter. They didn't increase their dividend by much. Their yield is higher and their payout ratio is also higher. However, when you have a payout ratio at 60% for CIBC, it's not the end of the world. As you know, overall, the banks like to have their payout ratio slightly under 50%, but in any case that we jump to 60%, you can sleep well at night. If you're an income-seeking investor, CIBC and Scotiabank will not stop increasing their dividend tomorrow morning, but they still give you signs of weaknesses that I don't really like personally. Moving on to the chart where we look at the results per segment, then you can see exactly what really happened. So long story short, when you look at this chart, you're going to know that capital markets sucked because you know what? We had a bad market. So whenever we have the bad market, most of the time they will make, all banks are going to make less money. They're going to lose some money on some trades as well. They're going to increase their provision for credit losses. And this is what we see here. Double-digit losses for most of them. Scotiabank at -8 and CIBC that did well in capital market. That's pretty much the only place that they did very well. In terms of wealth, most of them also show not a very interesting market, an interesting revenue. Why? Mostly because when the market goes down, this means that the assets under management goes down, like your portfolio value went down as well. And if you're paying a fee based on a percentage based on the assets under management, this is how they make a lot of money. Well, then unfortunately, they're making less revenue and then less income. Pretty good quarter for National Bank in terms of wealth, for up 24%. But what really hurt was the provision for credit losses, as it's pretty much a recurring theme across all banks. One thing that I'm a bit surprised though is Scotiabank, that didn't report big PCLs, especially for their international business that just thrived this time. So earnings up 38%. Keep in mind, that reminded me what happened in 2020. So the first quarter where we had COVID hit, all banks but Scotiabank increased largely their provision for credit losses. And then the following quarter, Scotiabank came in and said, you know what? Yeah, we have also to increase our provision for credit losses. And in the end, they pretty much, all banks, they move about the same weight in terms of provision for credit losses, but Scotiabank lagged on this one. So I'm expecting that maybe we're going to have a bad surprise in Q1 or Q2 of 23. But in the meantime, they're showing good numbers here. So that's very interesting. Again, they're still lagging behind the others. And for CIBC, that was like huge PCLs taken in the US side. That pretty much killed their quarter. In terms of PE ratio, what we see here is most of them are in their target around like 9 to 10 times their earnings. However, Royal Bank seems to be trading a little bit higher up, and BMO seems to be trading very low. And that is kind of like very strange, but that could happen from one quarter to another. Sometimes you have like a big movement in terms of numbers. Now it's better to look at the forward PE ratio to have a clearer idea. Now, when we do that, pretty much everybody is trading around that like 9-10 times the earnings. We have the same laggard here, Scotiabank and CIBC. And now you may wonder why those two banks are lagging behind on all metrics. Well, here's the thing. They lack of growth vector. So for CIBC, they have a more classic savings and loans bank business model, and they have a hard time to generate more money from wealth management or from capital markets or having like a more diversified business model. On top of that, during the last quarter, their wealth and their US part went very bad, so that hurt them a little bit more. And for a bank that has a trouble to generate like high single digit to double digit growth, well then when you have a speed bump, it hurts even more. For Scotiabank, the thesis is always the same. You want to have that international exposure, and then you go with Scotiabank. But one quarter out of like, I don't know, maybe every 2 years or something, there's a bad one saying, oh, you know what? We had some problems in South America or in Central America. We had to take a higher provision for credit losses. It's always like the same narrative that's happening over and over again. And for that reason, they are being penalized on the stock market. Is it going to continue forward? Well, I think that the burden of the proof lies on their shoulders. So they have to show us they can do a lot better. And until then, I don't think they're going to get any love from the market. So I told you that already, I think in my last video, but also on Twitter, that I would be adding EQB to my quarterly earnings review. I didn't put them in the other charts because they're not really comparable. They're really a savings and loans bank. They're just going after commercial and personal loans. And the other thing is it's a growth bank. They go a lot through digital banking. Actually, during the last quarter, their digital transaction went up by 63%. So it's a really low yield, high growth type of stock, not exactly well diversified as other banks and definitely not as big. To give you a growth idea, EQ Bank has a market cap of like 2.2 billions. Then the smallest of the big six, it's National Bank at 32 billion. And then if you want to go the other way around, Royal Bank shows a market capitalization of $185 billion. They actually just put $10 billion to buy HSBC assets in Canada. So just to give you an idea, they just wrote that check, boom, they did that. And they could pretty much buy EQ Bank if this is what they wanted. However, I don't think Canadian banks are that interested in EQ Bank. Why? Because EQ Bank is all about savings and loans, and all the other banks are trying to diversify their business model, not to concentrate it and increase their exposure to mortgage risk and credit default. In terms of the quarter, actually, EQ Bank did pretty well. Earnings per share went up by 14%, and what driven this great results was like loans. We're talking about personal loans volume up 27% and commercial loans up 34%. So with those amazing numbers, the stock year-to-date return is minus 15.5%. So pretty much in line with CIBC and Scotiabank, which is kind of weird because they are growing and the other two are not growing that fast. But the thing is, I think that the market is skeptical, and I am skeptical as well, for their PCL. So for their provision for credit losses, they claim, oh, we have like super stable PCLs and it's really great. And they mentioned in their latest quarter, it was like $5.4 million. So you thought, okay, 5.4, that's good. I guess it's a small bank. They don't have much loans, so it would make sense, right? But here's the thing. They have for more than $36 billion in loans. So we're talking about 15 bips. That's like 0.15%. It's nothing. And I'm kind of like, I don't know, I'm not very comfortable knowing that we have such a small PCLs that didn't increase much compared to the other banks. So is because EQ Bank is really confident in their underwriting process, the way they give out loans, and they think that everybody will be able to pay them off. And it will be business as usual, even though interest rates are increasing and so on? Or is it because they're a bit too much aggressive and not conservative enough, such as other banks, and it may bite them back in the future quarters? Even the CEO mentioned, you know what, next quarter it will be likely the same in terms of PCL. It's going to be pretty much stables around like that 15 bips, which is not much. So I'm just thinking, you know what, if it's true, then EQ Bank will do incredibly well in 23, but I still have my reserve on that part. Just to end on that note, dividend increases is incredible. So I told you already, it's a low yield, high growth. So we're talking about a yield of like around 1.5%, but the dividend started at like 18.5 and 18.5 cents up to 28 and then 29 and then 31, and the next quarter, the next payment you're going to receive, it's 33. So for a full year, we're talking about 78% dividend increase, which is incredible, right? Very impressed with how the way they grow. So they grow double digit for revenue, for loan volumes, for earnings per share, and more than double. I mean, it's high double digits for the dividend increases. I'm just concerned a little bit about the future, what's going to happen in 23 as interest rate seems to be on its way to continue to go up. So again, putting some reserve here, watching carefully, but still very well rated at DSR. It's rated as a pro rating of 4, so which means it's a buy, and a dividend safety score of 4 as well. So very safe and increasing dividend. So what we have learned this quarter? Well, first, we still got healthy volume growth in terms of loans for across all banks. They're making more money with the interest. So when you look at revenue, and I didn't talk about revenue too much because I don't think it's that relevant for banks. I rather focus on earnings and how the dividend goes. But if you look at the revenue, they went up like good time. I mean, I remember like National Bank was like growing double digit, but the thing is, Provision for credit losses, boom, they're still getting a little bit more, and it's going to continue this way for the coming quarters. What I like about that is banks are being very conservative, and what's going to happen next is if they are right, well, then they will already told us about that. So there won't be any surprises, and then the earnings are already affected, and then we're going to move on. But if they are wrong in a way that those loans are not at risk anymore, and then they come back into earnings, the earnings boost is going to go up very fast because they were going to be lower PCLs, and then we're just going to say, oh my God, like here's some more dividend growth increases, right? So again, the other thing that we have learned today is we have now kind of like two different types of banks. We have like the resilient one, and then we have the laggard, and this is starting to set apart a big time. So when you're late for a race, it's one thing, but after you're piling up the kilometers, and now we're like running like an ultra marathon, and you see that there's a distance that is being taken from like the pole position from the last one, and it seems to be, I don't know, not only going to say impossible, but very, very difficult for CIBC and Scotiabank to compete and outperform the other four. Banks aren't that generous right now. That they rather be conservative. They look at their dividend increases, but they don't want to be too much on that part. I don't expect in 23 that we're going to see double-digit dividend increases. I think we're going to go back to that 5-6% for the best banks. For the worst banks, not too sure what's going to happen. Maybe like 2-3%. They're going to be a little bit more conservative on that side, because you know what? When I look at PCLs increasing, some dividends slowing down for some banks, that the overall comment about the economy, I can think that banks are maybe expecting a recession. We saw that GDP for Canada went up by like 2.9 or 2.8%. That was very good, surprising actually. So maybe we're going to avoid that recession, but I don't know. We're increasing rates so fast, and then so many people will going to be tied up with those budgets. Not too sure it's going to happen. So you better be on the safe side. But in the end, right now, they're not overvalued. P ratio around like 9-10. It's really well conservative, going to get a good yield. So definitely a great place to be are in banks. You just have to be patient a little bit. Now, if you want a little bit more ideas than Canadian banks, I suggest you to hit the comment below. Look at the description for this video. We have a link for you to download the Dividend Rockstar. So this is a complete list of companies with having a strong dividend triangle. So we're talking about companies with revenue growings, earnings per share growings, dividend are growings for the past 5 years. Very good trend both on Canadian and US markets. You can download that in Excel spreadsheet. So very easy to download, play with, and bunch of metrics again. So just for your pleasure and research only. All right. Thank you so much for listening to this video. Let me know what you think about EQ Bank. Should I put more detail on this one? Are you curious about anything about this one? I'm going to continue to follow EQ Bank for sure for the next quarter. And don't forget to stay invested until the next video. Cheers.